Thanks, Annabelle. Appreciate the kind introduction. Hopefully, I can live up to her nice comments. And thank you all for taking time out of your day to listen to me talk about the Allianz Technology Trust. I truly appreciate it. I'm Mike Seidenberg. I'm the lead portfolio manager of the Allianz Technology Trust. I've worked on the product since 2009. I've been the lead portfolio manager since July of 2022. And we're going to spend some time today talking about technology, and we'll take it from there, and we'll have some Q&A. So if you were to leave this presentation with one thought and one differentiation, I think it really boils down to our team and how we view technology as a winner's game, not a loser's game. And there's an important distinction there in that, my background is I worked in software many decades ago, as you can probably tell by my age. And, when I worked at Oracle coming out of business school, cybersecurity was embedded in the software line item of a chief information officer. Today, there is not a chief information officer on this planet where cybersecurity doesn't have its own line item budgetary dollars or whatever the currency is. And what that means is if I'm a cybersecurity company, in a given year, I just have to worry about fighting for dollars versus my competition versus, in the case of software, infrastructure software, application software. So when we talk about technology being a winner's game, we actually talk about what we mean is there are new sectors that are, and I like to use the analogy of almost like when you see those icebergs come out of the water, which I'd love to see one of these days in my life. They're almost budgets are birthed out of a chief information officer's budget, over their total budget. So that's what we mean. So it's not a zero-sum game here. And if you go back and if you look at the amount of money companies have spent on technology over the past 25 years as a percentage of revenue, that trajectory is increasingly, they've spent more and more dollars on technology. And it's not because they want to spend money on technology. It's just if you think about what businesses care about, businesses really care about three things, right? Help me grow my revenues, help me decrease my costs, or help me increase customer satisfaction. And in today's world, where I would venture to say 98% of you are carrying a smartphone, technology creates that competitive advantage. And that trend is just getting louder, not quieter. Winner's game, not a loser's game. We believe that our proximity to the Silicon Valley allows us to identify these new emerging sectors, hopefully quicker than our competition. But at a minimum, it allows us to understand those technologies. And by the way, not every company is in Silicon Valley. They're great companies, globally, but a lot of these emerging themes are actually started in the Silicon Valley. So proximity with respect to helping us identify the companies, we have a consistent yet evolving investment process. It really is a mosaic, and it's something that we really pride ourselves on. And we have a long proven track record that we spend zero time thinking about because everybody in this room doesn't really care about what I did yesterday. They care about tomorrow. So I don't spend a lot of time on our track record. This slide is interesting in that not all sectors and technology are created equal. This just shows us the dispersion that we've seen year to date within the tech sector and how relevancy in areas of spend really matter. And therefore, when you're investing in this sector, you want to have a team and a process that can figure out where to spend their time. Because, if we had spent all of our time in software, which has been a not such a great sector, which is something we've actually traditionally had a large overweight to, that the trust would be having a fairly difficult year. The reality is, we need to figure out within a given year or 18 months and 24 months, what are those areas of spend and who is gaining and losing share from a relative perspective. So not all sectors are created equal. So we want to figure out, sectors that are, the most appealing in a given time period. So this slide is showing us the various trends that chief information officers are thinking in terms of having the largest impact on their business. The most interesting thing about this slide to me is, if you think about artificial intelligence, it was barely on the conversation a couple of years ago, and today it's the most important theme that businesses are thinking about. It doesn't surprise me that cybersecurity has been healthy throughout the whole time period, and it also doesn't surprise me that software as a service continues to do quite well, although not quite as well as some of the other things. But I think it's important from our perspective as we think about the trust, and the trust being diverse from not only a subsector perspective, but also diverse from a theme perspective, because we want to make sure that we can handle all types of environments. So getting the themes right is really important for us. We've all heard a lot about artificial intelligence, and I'm not going to spend a whole lot of time going into this slide because I'm sure you've read, all you have to do is pick up a newspaper and, it's pretty much top of mind in every newspaper I pick up. But I think the most interesting thing to me on this particular slide is just creating that competitive advantage, which I talked about earlier, that 64% of respondents in this KPMG survey thought that artificial intelligence would allow them to create competitive advantage. And what that means in the real world is you can't not trial it, right? You can't not figure it out for your business. And by the way, the returns are going to be different for varying businesses, right? I'd make the argument medical technologies may have a very different return profile than energy. But all businesses today are looking at artificial intelligence and trying to figure out what it means to their business. And this revolution that I've been a part of, I came into technology in the mid-90s. And I often say that, when I worked at Oracle, we knew the questions we wanted to ask from our applications, but we just didn't have cheap compute and storage. And now we have that. So we're living in a world where companies have the opportunity to run really sophisticated algorithms against massive data sets. And that's the journey that we see here, right? The journey today, we've gone through an analytical journey and machine learning, and now we're the next journey. And by the way, I don't think we're gonna have, human intelligence computing tomorrow, but we'll get there eventually. And we're living in a time where we're just able to look at just incredible data sets and apply algorithms that start to mimic cognitive intelligence, and that's something that's been part of a journey, and we're on that continuum. And by the way, we're not going backwards. Technology doesn't go backwards. No one in this room says, oh, by the way, I want the Razor phone again. I'll give you back my iPhone. I'm not really happy with the results here. So, it's a journey. Technology moves forward. It's an industry whereby countries like the UK and the United States are leaders. We have very strong leads in this industry. So we're not going backwards. Par and parcel with artificial intelligence comes this massive investment that's occurring right now. This is just a staggering amount of capital spend if you think about what is occurring in order to drive the results that I was talking about. So therefore, if you think about the trust, we have exposure to companies that can participate in this capital spend. I found this slide to be really interesting to the extent that, during the pandemic, we had a large amount of spend by many organizations to get everybody productive. And now we've been living in this digestion phase, which has been fairly painful for tech. But we're just now starting to see some of those green shoots of IT budgets starting to expand again. And I think it's really driven by a couple of things. Users of technology, whether it's a good economy or bad, inside businesses, their demands on IT remain fairly consistent. Everybody wants the newest application. Everybody wants something that allows them to, get in contact with their customer more effectively. And that's been curtailed vis-a-vis IT departments as everybody digested what they bought during the pandemic. But they can't curtail it for too long because you run the risk of not doing anything and your competitor doing something, and therefore you could, lose share or potentially, in a worst case scenario, be Amazoned by someone. So I think this is a nice healthy trend that I'm seeing here. And by the way, I would comment, this is not, you can see this isn't a huge order of magnitude improvement, but it's a nice gradual improvement, and hopefully 25 will be better than 24, although the jury's out. The semiconductor cycle is something that is important in technology investing, and it's specifically very important in the trust. We're still pretty early days on the semi side. There's been some zigs and zags. I would expect that to continue. But if you just think about semiconductor content and the proliferation that we've seen, all you have to do is go into a new car and look at all the safety features and the amount of silicon content that are going in those vehicles, industrial equipment, and obviously without saying, data centers, it goes without saying. I mean, they consume just massive amounts of semiconductor content vis-a-vis chips as well as memory. I often jokingly say to our investors that, cybersecurity is probably the most durable neighborhood in tech. 15 years from now, when I may not be here talking to you because hopefully I may be retired, cybersecurity will still be in the room, and it is a necessary spin by organizations, and it's kind of there are two different factors here. We as consumers, whether you're a business, if you're a business or a consumer, everybody is digital, right? If you think about John Deere, right? John Deere is now, they are selling their agricultural equipment as that farmer drives around the field. There's so people's digital presence is very much in the forefront. And if you think about just how people are working, right? You may go to the office in the morning, go to a cafe in the afternoon to work, and then in the evening check your email. You could use a different device, right? You could use a PC at work, and then you use an iPad in the afternoon, and then you're checking on your smartphone. Those are three different points on the network that make you very vulnerable. And so we, as a society, have much more presence on the network, yet at the same time, the adversaries are increasingly sophisticated. It isn't, six people that went to uni together trying to hack into a high street retailer, right? It is nation states with multi-billion-dollar budgets that look at cyber warfare as a way to create competitive advantage. And therefore, cybersecurity, in my opinion, is the most durable neighborhood in tech, in that it is a necessary spin. And add to that, boards of directors pushing pressure down to that CEO, whether she or he, do the companies have the right cyber security procedures in place? So that's what's driving the spin. And when you see something like 11.6%, call it 12% until 2030, that's just a really healthy growth rate. And it's a layered approach now, right? You can see on the bottom all the different layers of security, because you can't just have a firewall. A firewall isn't sufficient because you need redundancies in your system given how sophisticated your adversaries are. Cloud penetration is something we've talked about previously. I'm sure you've heard a lot about it. It's still early days with respect to workloads moving from on-premise to the cloud. If you've listened to the last couple of conference calls, whether it's Amazon, Andy Jassy is the CEO, talking about cloud workloads, starting to move from on-prem to the cloud. We're still early days here, and it's been a theme of the trust for a while now, and I think it persists. I think it's important when you think about investing in technology to make sure that whomever you invest with has a variety of different themes in their portfolio. And this is just a snapshot of the various themes we have exposure to. in the trust. And obviously, these numbers can move around depending on the names, and certain companies could cover 3 of these different themes. But the point here is that make sure that you're investing in something that's diversified, and diversified not only from a company perspective, but also diversified from a thematic perspective. So the team, and I'll spend a few minutes just on more of the operational issues as we move towards Q&A. It's very much a team-based process. I work very closely with my coworkers, trying to figure out the businesses that we should be investing in. This is definitely not a dictatorship from a portfolio perspective. I make every buy and sell decision, but I work closely with the analyst pool to make sure that their conviction is represented in the portfolio. And over time, we think that that's just a better way of investing. I mean, I've worked in other situations where the portfolio manager was fairly dictatorial, and that was a pretty difficult way to work. So, I think I've learned something along the way in my career. We really are focused on, call it mid-cap, large-cap opportunities, because the process really lends itself to identify of these companies. These companies tend to be kind of in the mid-cap, large-cap space. The trust is approximately 1.5 billion pounds, so I didn't say dollars, which I sometimes do. The team collectively manages, I think we just went over 6 billion, because this is kind of a stale number, but the funds have had a pretty good near-term run. And the San Francisco office collectively manages about 16 billion pounds. Uh-oh. Oh, good. Shoot, almost a tech error. So this is the team I work with. Everybody has individual name coverage, including myself, and I think that I learned a few things from my predecessor, but one of them is, as a portfolio manager, when you have coverage, it keeps you really fresh, keeps you focused on idea generation. So everybody has individual coverage. We meet every morning, Monday through Friday at 6:50. We catch up with one another to figure out what's going on in our respective sectors. We meet to discuss the portfolio twice a week in a structured setting, but obviously communicate amongst ourselves. And there'll be 2 and 3 people on a call just to figure out kind of what's going on with the business. So it really is a collaborative environment. We have a great amount of support, as you can see underneath this slide, vis-a-vis some quantitative oversights, risk management, et cetera, et cetera. So as we wrap up, this is a strategy that's designed to perform. It's predicated on a multi-pronged investment process. We think that, not only do you want to, talk to companies, but you want to go visit them. So it really is a boots on the ground type of strategy, whereby we look at a variety of inputs. Those inputs aren't just companies, they're private competitors, they're system integrators, they're chief information officers. We think about owning the number 1 or 2 players, and a lot of times I get asked, why is that? Because I want to mitigate blow-up risks. And I often remind the team that good ideas are a dime a dozen, but execution is rare. So I'm willing to pay a higher price for companies that execute better, and those tend to be the number 1 or 2 players, because I have enough risk as it is in technology. So I'm willing to really focus on the number 1 or 2 player. And then diversity. Diversity not only at a subsector level, so subsector meaning semiconductor equipment, cybersecurity, all the various subsectors, and I don't need to list them all, but also diversification by style, making sure that we think about the portfolio as an organism that can handle a variety of environments. So we might have certain tilts, like we may tilt towards high growth or value depending on the macro, but making sure we don't have too much style risk.
Okay, the really good news is Mike's left lots of time for questions, and I can see somebody's really keen here right in the front row. That's what I like to see. Get those questions in.
Yes. Could you update us on the technology race between America and China?
Yeah, it's a great question. I don't know if I think of it as a race so much as, you're seeing a lot of posturing politically between the 2 countries with respect to intellectual property, not particularly liking one another. it's in the country's best interest in both of them is to continue to trade. Obviously, a lot of equipment from the United States and on the semiconductor side goes into China. China happens to manufacture a lot of the chips as well. So that's not leading edge so much, but some of the trailing edge chips. So from an economic perspective, one would think that it behooves them to try to, facilitate some type of stalemate with respect to their unhappiness with each other. It's something that's talked about a lot, and we factor it into our decision making. I recently did exercise for the board around Taiwan, which is a similar question to your question. And what we basically realized was that if China were to invade Taiwan, what it does to the global supply chain, you really can't protect yourself. I mean, we're living in a very global world. Automobiles in this country would cease to come off production lines because they're dependent on chips that are made in Taiwan that go into final assembly, and you really can't diversify away from that. So, unfortunately or fortunately, the global supply chain is real. We saw it during the pandemic, and, as we sit here today and think about the U.S. and China, we factor it into our decision making, but there's really no way to run a trust that didn't have some exposure to that potential political risk. It would be very difficult as a tech manager to diversify away from that.
Thanks so much. Right, questions? I can see two there at the back, one in the middle. Should we go in the middle first, if you can get there?
Yeah, thank you very much. I'm a private investor, but also in my career role, I have been the subject, along with my colleagues, of Russian state hacking, so I'm aware very much of the security issues. My question follows on from your points on that. I think it's the case that ASML has been described, perhaps in more ways than one, as Europe's most valuable tech company. What about, both in Europe and in the Far East and in North America, the sort of sub-ASMLs? Well, do you invest in those and research them? Thank you.
Yeah, so the opportunity set is tech broadly speaking. When you think about specifically lithography and what ASML does, I mean, remember at one point, and I'm old enough to remember it, there were 4 competitors in that space, right? ASML basically now owns the space, and they're incredibly good at what they do, and the Japanese competitors really aren't relevant in leading edge lithography. But we take a supply chain approach to something like what you're articulating. So we may go and look at, for example, at times we've owned like a lens company, which obviously is a key ingredient that goes in lithography. So one thing I like to try to do as an investor is think in terms of first and second derivatives. For example, back in the day, there was a product called the Wii, right? Which was this wonderful product by Nintendo. And we figured out who made the gyroscope controller in the handheld. And that would be a great example of, we made way more money on the gyroscope company than we ever did on Nintendo, which, by the way, wasn't a pure play on the Wii because there was a handheld aspect to the business. So yeah, I mean, we definitely think in terms of food chain and in terms of value chain, making sure if you like something, to get exposure to it in multiple ways. Currently, if I think about artificial intelligence, we're getting exposure. Obviously, there's exposure through something pure like NVIDIA, but there's also a company called Monolithic Power that is part of the AI equation that probably isn't as well known, but is a fairly healthy sized position in the trust. In fact, I had my board in town a couple weeks ago, and we had the pleasure of going down there and meeting with them. And you just walk away and you realize that this company is not only a play on artificial intelligence, but it's a play on semiconductor power management, which is relevant in just so many industries. So it's a great question, but yeah, I really think in terms of, I love to try to find as many ways to express it as possible.
Thanks so much. I know we've got a question right at the back there. Thank you.
Thank you. Related to that, how exposed are you to the Magnificent Seven, or have you gone down to the Magnificent 14 that follow them?
It's a good question. The Magnificent Seven has been a pretty tough headwind against the trust the past few years. So I have used capital in order to basically, I think of it in terms of flanking them, because to have no exposure to them, despite the fact that we are focused more on large cap, mid cap, my guess is the people in this room probably wouldn't be very happy with the performance if we didn't have some exposure. So the only one we were overweight actively, and we got there vis-a-vis appreciation, is Meta, which I can digress into why we bought it in late 2022. But, I've had to use capital in order to make sure that I live to play another day, so to speak, which is something I learned early in my career, that, people are patient, but people aren't infinitely patient. And it's something I think about. But over time, if the markets play out the way I'm thinking about it, I will take capital out of the Magnificent Seven and redeploy it in smaller companies, because there'll come a time, it may not be, today or a year from now, there'll come a time if technology is going to work, it can't just be in 7 names. And I think it's also worth noting, I have a very active board that is great for everybody in this room, because anything above an 8.5% position it begins with an email to the chairman, who I assume, chairperson, sorry, who I assume, sends it to everybody else. But then if we were to take something to 10%, it becomes a discussion with the board. There's, single stock risk. If I often think about when I run, as the portfolio manager of the trust, my goal is to make sure that someone like my mother, who could be an investor, isn't taking on too much single stock risk. And I take that job really seriously. So, I'm willing to be underweight relative to the benchmark, because I think it's the right thing to do for our shareholders over time. So,
Great. Tamara? It's behind.
Thank you. Just a question on the generative AI and the sustainability of the trend. Am I the only one who's concerned about the nuclear power aspect of this?
No, I'm concerned by that.
Right. I just...
3 Mile Island happened in the United States. So yeah, there is concern there.
So with Bill Gates being very much in train with his SMR reactors, at what point do you think the US public would say, this is unsustainable, this isn't good from an ESG point of view?
Sure, it's an interesting question, and obviously one, I think I'm as surprised as anyone when I heard about 3 Mile Island, the second reactor, starting to be used for Microsoft's benefit. Look, what we haven't seen, and I think that the real litmus test is the day they build a new nuclear reactor, right? Because if you're really committed to this type of power, you have to build new ones. So we haven't seen that yet. I think it's TBD. It's interesting. I also think the American public, like most publics around the world, maybe with the exception of France, are terrified of nuclear power. I think that the concept of, rightly or wrongly, people, everybody has this, fear of radiation, present company included. So I think we're still, it's a trial period. When they build a new nuclear reactor, that's when you know that that it's real.
Okay, we're running short on time, so if we have a question, it's going to have to be a really quick one. I can see there's one there. It's going to be quick.
As in 15 seconds?
As in very quick.
This is a slight sci-fi question, or a slant on sci-fi. In America, I know MIT and several high-worth individuals are looking at the process behind the science of aging. Do you ever think we'll get to the point where we see complete human brain loads up to a computer so that we actually have a digital presence?
Yeah, wow. Well, if it's I'd love not to age, but the answer is I don't know. It's, it's really, I think we're going to have systems that are very cognitively aware. I really have no insight in that. It's just not my area of focus, so I'd hate to lead you down the path with respect to whether or not, in our brains, we really don't do a whole lot of, we don't do any biotech or mid-tech, and I'm sure there's someone who probably have a better answer than I have around that.
Okay, I'm afraid we're out of time. I have to say, I'm really glad that Mike's thinking about his mother, not too much exposure to one stock. Us shareholders like this kind of thing.
She's not here, by the way.
I'm also quite pleased Mike says, in time, I might be moving money from the Magnificent Seven into the mid-cap stocks. I'm glad we've got someone like Mike making those kind of decisions. So really brings forward the value of the investment trust structure. So thanks so much to you and Mike. It's been a great session.
Thanks.